And for more insight on world markets, we are joined now on Skype by Laurence Schreiber of Clarity Capital. Thank you very much for being with us.
My pleasure, Natalie. Nice to be here.
Well, we've recently been seeing tremendous volatility in global equity markets. What has happened and what is causing this?
Absolutely. It's been a very impressive series of moves over the last week. Literally, it's just been a week since things started moving. If you take a big picture, it's kind of to be expected. We've had a 6-year, almost continuous rally in developed market equities, US, Europe, and parts of Asia. It's unusual to have such a long period of time go by without a significant pullback. And typically it's healthy for markets to pull back from time to time, which is why people actually call it a correction. They think it's just a rebalancing of markets. If you ask what the drivers were, people really got nervous about China. Was a major one. We started to see some less positive economic numbers, not negative, but just less positive. And equities in China got really put under stress as a result. And people started wondering, does that mean the global economy is slowing down? We're seeing oil prices lower, which might indicate that. And it led to a kind of panic selling around the world.
Well, you mentioned this kind of correction here. Are these types of dramatic moves normal?
Absolutely, they are. We see throughout every cycle multiple corrections. And typically people define a correction as at least a 10% move or greater from the most recent high to current levels. We get those from time to time. What made this one unusual was to see a 10% drop. In fact, the S&P, which is the S&P 500, which is the largest index in the world, most liquid one in the US, moved 12% in 4 days from the highs to the lows. And that's unusual. We've only seen about 8 or 9 of those in the last 100 years. So it was a rapid move, but it wasn't necessarily bigger than what we normally expect.
Interesting. Well, what impact are we going to see in other major asset classes like bonds, commodities, from all of this volatility?
Oh, absolutely. It is a volatile period, and people have to remember that the last few years have been atypical. We're getting back into more normal market volatility. So, of course, these last 4 or 5 trading days have been unusually large, but it's not unusual for investments to move up and down over time. So we've seen those types of moves in emerging market currencies. We've seen them now in commodities as well, as I discussed, but gold as well has been fairly volatile. I think we're back into a more typical period of volatility, and we're going to expect up and down.
All right. And where do we go from here?
Oh, that's a great question. As markets were really collapsing this past Monday, our firm sent out a note to all of our clients saying, we don't think this is the end of the long-term economic cycle. This is different, we felt, and we still feel, than the 2008 period or even the 2001 period, where we were recovering from a bubble. Now there's really no bubble, at least in the assets that are selling off dramatically. Things have been a little more highly valued, but not massively overvalued. So we think this is a correction. It's part of the normal course of market movements, and we would expect to kind of move back to normal signs. I wouldn't panic.
Well, Laurence Schreiber, thank you very much for bringing this to our attention.
Oh, it's my pleasure, Natalie. Thank you for having me.